Hey, hey, hey. Pardon the informality, but I could use some lipstick. My technology's not working, but that is okay because I really wanted to do this video today. I'm on the river and it is so beautiful outside. And thank you so much for being with me, watching this now, watching this later. I called it Credit 101 because I've got this document that's over 40 pages long from Experian. And it's got a lot of great information I'm going to go through. That's what I'll be looking at today, and I'll be sharing that information and so on and so forth. I spent probably 15 minutes trying to get the camera right, which I'm having trouble with my stand, so I couldn't do that. And then I was going live, and I went landscape, but then it made me change to portrait, so then I had to reset everything, but then the holder won't hold it in portrait, but then, it's like, okay, so then I did it in portrait and it said spin it around. So I don't know. This is what we're doing. I hope I'm not sideways. I hope I'm not crooked. So let's dive right in. So this is according to Experian, because that's a 40-page document, and I'll actually put like a link, to it so y'all can have every single page. But it's called The Ultimate Guide to Understanding and Improving Your Credit. All right. So we're going to start, simple. It starts real simple with saying, what is your credit, or what is credit? Okay. Open credit card accounts in the United States as of 2020 is 497 million. Oh my goodness, that is crazy. Right now, 90% of U.S. customers have at least one credit card account listed on their credit report. The average outstanding credit balance, the average outstanding credit card balance is $5,315. What is credit? It's the ability to buy things today using borrowed funds and pay back the purchase over time. Americans rely on credit to the tune of trillions of dollars to pay for many of life's big ticket items, ranging from cars to education to homes. In fact, establishing and maintaining good credit will very well determine what kind of home you can live in, from the ability to pass a landlord's credit check to securing a mortgage or a home improvement loan. Credit scores are based on the contents of your credit files at the national bureaus. It's a record of the history of you borrowing and repaying money. Now, why does your credit matter? When you apply for a loan or credit card, the lender uses your score as kind of a shortcut to estimating your credit worthiness or your likelihood to repay. Think of it as an indicator of your financial fitness. As part of their review, lenders consider your credit history, your track record of handling debt and paying your bills. For many lenders, evidence is solid credit management experience. That's going to be a prerequisite for considering you as a borrower for many, many lenders. And what we're going to go through today, it's in this guide, we're going to point out the many connections between personal financial habits, the credit reports that document them, and the credit scores that distill them down to a simple but hardly simplistic 3-digit number. Now, why is it important to understand credit? Your credit is basically your reputation around how you handle money. If you have a good reputation, it can be a powerful tool to help you improve your lifestyle by allowing you to buy things that you might have to save for years and years to be able to have enough money in order to buy those things. Talking about homes specifically, in terms of dollar volume, mortgage loans are the largest component of consumer debt by a wide margin. In the third quarter of 2020, balances on U.S. loans totaled $10.3 trillion, up to $9.6 trillion, or up from $9.6 trillion in 2019. That's according to Experian. In Q3 of 2020, the nation's total outstanding student loan balance increased to an all-time high of $1.57 trillion. That's up from $1.4 trillion in 2019. Again, that's from Experian. Now, when it comes to cars and to auto loan balances are the third largest source of debt in the US, having grown to a total of 1.35 trillion in Q3 of 2020, up from 1.3 trillion in 2019. And that's according to, again, Experian. Now, what's crazy is we're talking about, cars right there. Everything I've researched recently says that the cost of a used car is up 40%. That's crazy, 40%. It's wild how everything's just like costing us more and more and more these days. All right, so now what we're gonna do is we are going to discuss here the 4 different types of credit. Okay. The types of credit differ in a few important ways, such as their repayment schedules, and the amount required for each down payment. Number 1 is installment credit. With installment credit, a creditor loans you a specific amount of money and you agree to pay them back. That sum plus interest in a series of fixed payments or installments over a set period of time. An auto loan where you make payments of $300 a month for 48 months is an example of an installment loan. Home mortgages and student loans are other examples of installment credit. Okay, the second type of credit, revolving credit. With revolving credit, the lender permits you to borrow variable amounts up to a maximum credit limit. You can use some or all of that amount to make purchases and then repay what you borrowed in monthly payments of varying amounts. Aside from a minimum payment required, you can carry outstanding balances forward over 1 or more months, a process known as revolving the debt. But as you do so, the debt typically accumulates interest charges. Most credit cards are a form of revolving credit, and most credit cards are interest rates that are freaking insane, like 14 to 30%. Now, the third type of credit are charge cards, okay? Charge cards. You make purchases with a charge card the same way you do with a revolving credit card. But the charge accounts require you to pay back whatever you've borrowed in full each month without carrying a balance forward. In exchange, they spare you the interest and the finance charges. So you basically use their money for free for 30 days and then you pay the balance in full. And the fourth type of credit is service credit. Your contracts with service providers are all credit arrangements. You receive electricity, cell phone, gym membership, and so on the condition that you will pay that each and every month. Now, they go into why you need credit. I think that, that's kind of a given. We talked about that a little bit. And the next thing that it goes into is if you have good or excellent credit. With a good, solid credit reputation, you can apply for rewards credit cards. That can provide you with even greater advantages, such as cashback refunds based on a percentage of your card purchases, credit towards airline miles or hotel stays, or points that can be used to purchase a variety of goods and services. The importance of good credit also extends beyond purchases. Potential employers, landlords, service providers, all of these types may use your credit information to help decide whether or not they actually want to work with you. And now here's the truth they're providing. If you have no need to borrow money, your credit doesn't matter. But at some point in all of our lives, we'll need to borrow money for some reason, and so you want to be prepared for that. Here's the truth. Credit checks are often required in connection with employment screenings, home or apartment rentals, and new accounts. And even accounts like you're getting a new cell phone, they're going to look at that and consider you, right? All right, so we want you to know your rights. A federal regulation known as the Fair Credit Reporting Act guarantees your rights when employers, landlords, service companies, and yes, even lenders use your credit history to make decisions about whether or not they want to work with you and or how much they're going to charge you. Number 1, businesses must have a permissible purpose under the law to access your credit, such as lenders checking your report as part of a loan application review. Number 2, if a business decides to charge you higher fees, require extra deposits, or decide against doing business with you based on your information and your credit history, they must explain that in writing. And number 3, if you believe information reflected on your credit history is inaccurate, you actually have the right to dispute that. And that's why I say you want to pull your credit twice every single year. That way you can look at what's going on, dispute things that are wrong, and make sure that the information is accurate and that no one has stolen your identity. Now, what determines whether credit is good? Lenders want borrowers who have a history of making timely payments on other loans and bills, that are at a low risk of default, in other words, going 90 days or longer without making a payment, and have the means to pay back their loans. Now, you're in charge because your credit worthiness is based on your financial history. You're in the driver's seat. If you want great credit, you can have it once you understand how that process works. Think of a good credit score as a reflection of a lender's confidence in your ability and willingness to pay back whatever money they lend you, plus interest charges on the schedule you agree to pay back and accept that loan. When deciding whether or not to accept a particular borrower's credit application, lenders analyze it in terms of risk. They view borrowers who are highly likely to repay loans as low risk and others as a higher risk. Lenders differ in their tolerance for risk with the specific risk profiles, and while they might disagree on precisely how to define it, all lenders do agree that some applicants are too risky to take on as a borrower. So how do lenders determine how risky a borrower is? And what do they look for in an ideal borrower? Well, guess what? I'm going to leave you there at that cliffhanger, and I'm going to pick back up with this. We've got a lot more to go. It's great information, and I hope to see you next time I jump in live to pick up from where we've left off, what determines whether or not the credit is good. Don't you want to know? Please be sure to tune in so that I can definitely give you and share those answers.